Hi everyone, welcome to the webinar. Welcome one and all to the webinar. Well, I bet this is well awaited. I can tell from the numbers it will be. Let me know where you're from if this is your first time on. And let's start sharing the screen. I wish everybody was this interested when the markets are rising as they are when the markets are falling. I've got a lot of good stuff to share with you. Here we go. Right. Okay, you should be able to see the screen. So my weekly stock market update. Now, this is different to what my clients receive. So any clients watching this do not have a heart attack that I'm giving away the crown jewels. Okay, I'm not. Calm down, both of you who worry. Everybody else doesn't. There's two clients I have who just worry every time I speak to the public or I appear in the public or I'm on TV. They have a heart attack saying, why are you not in hiding? So these kind of falls are not unusual. The 20% bear market is unusual. The 10% correction we had isn't. Okay, that doesn't mean that we should not have gone into cash. And I'll tell you what I've sold in just a second. Zurich, I'm going to be in Zurich, Stefan, in about 10 days. So we've got people from lovely Greece, Staffordshire, Willis. I've just got back from the United States where I was out there speaking to investors. I'll update you on that. Jeff from Australia, welcome one and all. Thank you. Thanks, Graham, as well. And beautiful Kingston upon Thames. I love it around there, the boat clubs. Now, it was quite fast, was this? And as Warren Buffett says, sometimes you go from green to red and skip amber altogether. And that meant that the gains which I thought I had ended up being a bit smaller than I thought I had because, hey, it moves so quickly. Just so you know, that is normal. If you count your chickens and you think you're wealthier than you are, it only counts when you've exited. And so, as I'm going to show on the charts, like in 2022, I guess I was a bit slow getting out of some positions. Actually, I was slow getting out of all positions because I tend not to get out prematurely. And I should have got out of Microsoft sooner, but I'm going to go through all of that in just a second. I'm also going to tell you what I'm still holding. Again, none of it breaks the rules on client confidentiality and what I give my clients. I thought this is interesting. You might want to take a picture of this. S&P 500 performance after closing in correction territory. We're now in bear territory, if I'm not mistaken. And I'm going to give you an assessment of what I think is going to happen shortly as well. Stefan, do I have time for a coffee? I'm not sure. I might do. Do ping me. This is for Zurich, yeah? I should do, actually. I'm only there one night. I'm speaking to investors out there. I've got some events that I'm hosting for investors, and the parties tend to be quite fun. Now, this is what tends to happen 1 year on. More often than not, you're up. You're positive within 1 year of a correction, 86% of the time. In other words, you're pretty much guaranteed. After 6 months, 73% of the time. After just even 3 months, more often than not, you're in positive territory, which is interesting for all the panic that happens in the market at the moment. I'll talk macroeconomics a little bit later on the Mar-a-Lago Accords. I can tell you the Americans that I spoke to from all over the United States and the hedge fund managers, it was just two issues that they had in mind. And none of them asked my opinion, not because they don't care about my opinion. They didn't ask anybody's opinion. They seemed to be very assured because they're experienced with the US markets, and they fell into two categories. Those who said, well, I'm just holding through the storm. I've seen it before. Even the ones who were close to retirement, which I thought was interesting. And then the other batch who said, oh, I'm holding fire. I can't wait to get back in. As one hedge fund manager said it, I love the Mag 7. I can't believe I'm holding cash at the moment, but I can't wait to get back in, because they know the returns they're going to make. And I'm going to give you some of the stocks where I intend to get 100% return. Some of them will be these. I'm not in any of these at the moment. However, from these, depending on the size of their falls, now listen carefully, depending on the size of their falls, I will be getting in, and here's the interesting maths that I've done, and it's not going to be yet. It's not going to be yet. It'll be on one of these broadcasts in the future, I'll tell you. And this is important. It's not yet, because any one of these could easily fall another 50%. Probably not Berkshire, but the others certainly could. Now, like with 2022, after the markets fell, I'm going to share some maths with you. You should be able to see my screen. Let me just double check. You can see my screen. Okay, I'm going to share some really interesting maths with you that I did this afternoon. Now, let's say, for argument's sake, it was Meta, okay? And then, as in 2023, I got back in. And this is unleveraged, okay? And I'm not saying when I'm going to get in, because I don't know yet. I just don't know yet, but I'll tell you when in a second. Now, let's say I get in, I don't know, 6 months from now, and it'll be on one of these broadcasts I'll tell you, and let's say it's Meta or an Eli Lilly. It'll be some of these, not necessarily all of these, because I don't know how much further they're going to fall, but it'll certainly be from this list, okay? Only the ones where I anticipate, should they return to their all-time highs and continue their long-term 7-year trend, I will get 100% return. And if that happens, and if it takes, now let me give you, this is where the interesting maths gets in. If it takes 5 years for them to do that, which is longer than I expect, then I'll only be earning 15% per annum for those 5 years. If it takes them, however, 3 years, I'll be making 26% per annum, right? Last time they did it in 2 years, most of them, which meant I was getting closer to, actually, that's a good one. In 2 years, that works out at, doesn't quite work out 50% per annum because of the way compounding works. But if you get it in 2 years, it works out at an annual rate of 41% per annum. Okay. Now, let me say that again, and let me be really, really clear, because the subtlety is lost on people. Not yet. And that's critical, because if I get in now and they drop another 50%, then I've just wasted a load of time, energy, money. Okay. And at the point I do, it'll be one of these weekly updates, and I'll update people. And I'll only get into the ones where I think that if they hit their all-time high and or continue on their long-term upward trend, I'll make 100%. I would not be getting in yet. So those of you who are my clients, don't have a heart attack that I've just given away the crown jewels. I haven't, because it wouldn't be yet. You could easily blow your hands off getting into any of these too early. Got it? Okay. So this, by the way, this data is not bang up to date, obviously, because the bloody data changes every minute. Okay. So it'll be some of these, and that will give me the rules. Donald's asked, do the normal rules of recovery applies? This is not a normal correction, but due to the action of one person. Donald, it is perfectly normal. Okay. COVID was perfectly normal, and the normal rules applied during COVID, which was as abnormal as it gets. The financial crisis where Lehman Brothers went bust and the S&P dropped 50% wasn't normal, and the normal rules applied. The dot-com bubble wasn't normal. None of them are ever normal by their nature. Okay, and if you think this time is different, I'm sorry, this time isn't different. As Warren Buffett famously put it after the Second World War, he's seen assassinations, flu epidemics, oil price shocks and crisis, the Cold War, presidents having to resign, presidents being impeached, Nixon. Was he impeached? No, Trump. And despite all of that, the one thing that remained assured, a numerous financial crisis, was the bloody thing kept going up and everything was normal. The one thing which was normal were the recoveries. So those people who don't think it is, they're the ones who stay out too long and get screwed. I'm not getting in yet. No, I'm not getting in yet, and I'll tell you what the rule for me is in just a second. Okay, so no, it's not a buying opportunity yet. There's going to be a whole bunch of people getting in too soon. I don't get in when it's falling. I am a laggard. I lag. I, like Winton Capital, the famous hedge fund, and many other hedge funds, I get in late. I get in here or here, God forbid even there. I never get in while that is happening. Okay, so if you're expecting me to get in early, why the hell would I want to get in early? If you've read any of my books, I recommend net trading. I discussed this point 25 to 30 years ago, that basically prices move like this, as we know, and every idiot and their grandson is trying to get in at this point for some weird reason. Worse still, they're trying to get in at this point for some idiotic reason, instead of just being patient and trying to get in there instead. Now, of course, it can either go like this and then back down, but at least you've reduced the probabilities to 50-50, whereas this could keep going down like this forever and a day, and similarly, this gives you no evidence that it's still not on a downward trend. So the first two, you're on a downward trend and you're just getting into them. The third one's the only one where you've got at least on random a 50-50 chance. On the other two, you've got more than a 50-50 chance of falling. You've got a 66% chance of getting into a falling market. And that's if markets are random. Let's assume they're random. Do you see what I mean? Okay, so not at the moment. And I have a very simple rule for determining when. And I'll tell you what's interesting. Right. Let me tell you something. And this bit I've said before. There's nothing I'm going to tell you today I've not said before, but maybe now people will listen. Although I have degrees in philosophy, politics, economics, and in law, none of those things are useful for determining the direction of markets. You know what's useful? Where people are putting their money. What people are doing, not what they're saying. Everybody who's interested in narratives and what people are saying are trying to get in early or call the bottom for some weird reason, because statistically they're going to get their fingers burnt. I've just shown you on simple mathematics. I wait until they put their money where their mouth is, and I see those average prices rising, and I get in, oh, you got in a bit late. Late to what? Oh, the hypothetical bottom, which the tooth fairy could have worked out. Great. Fine. So what? I'd rather be late than early and lose more. And for all those people trying to be amateur economists, there's an old saying, put two economists in a room, you'll get three views. Now, hey, they even gave me a master's degree in economics. I forgot about that. And I'm telling you what my tutor told me when I went for interview for admission to my university. He said, because he knew that I was interested in investing, he said, you know, economics won't help you with the stock market. And I said, yeah, I know that. I've been bloody doing it long enough to know that. So all those people trying to second guess and be amateur economists, you might as well go back to being amateur doctors and diagnosing everybody's got cancer each time somebody says they've got, foot ache. It's a nature of private individuals that they do crazy stuff and Google stuff, right? Forget the economics. See where they're putting their money. Because if they don't put their money behind it, ain't going to move. All right? You can talk all you want, but if the price doesn't go up because nobody's put money behind it, then talk is cheap. So are stocks increasingly, which is good. Right. So where does that leave us? It leaves us with looking at prices, not looking at narratives. And my point to you is this. I think I'm pretty well equipped, and I've said it in many webinars before. If those of you who've been watching for a long time will know, I've often said I could bore the pants off you talking about, I used to say, trade balances and the the niceties of macroeconomics. Got nothing to do with the stock market. I'm telling you, as somebody with all those bloody degrees, I'm not bragging, because what I'm telling you is they're worthless for this stuff, and somebody who manages capital professionally, it's all got to do with the prices, not with the macroeconomics, because the macroeconomics is in the price. Everybody talks a lot of narrative, a lot of noise. I'm not saying economics is a bad discipline, or politics. I mean, what a degree. Philosophy, politics, economics, and shove in laws a separate degree. You know it all. Utterly useless for this stuff. Always known it. Said it before. It's all fine. This I don't really care about at the moment, and I don't think my 100% gainers are going to come from here. I'll probably avoid the Tesla side of stuff just because the volatility is mental. It'll be the less volatile ones. Now, you might remember this from an earlier webinar where I said, people are always asking me, what should I do with Rolls-Royce? What should I do with or any stock which has gone up a lot? And remember the old rule. I'm not going to tell you anything new in this webinar in one perverse way, which is if it drops X, sell Y. That hasn't changed. That hasn't changed. So X, Y, what is that? So if it drops 10%, sell based on your risk appetite. Based on your risk appetite, you might sell 10, you might sell 20, you might sell 25. If it drops 15, 20. My point being, I don't know what the future holds. And this is an old chart. I don't even know what's happened to Rolls-Royce since then. Can anybody tell me? That was when it was at 771. Could somebody tell me where it is at the moment? I don't own Rolls-Royce, by the way. Okay, can somebody tell me where it is at the moment? My point being, what I said before in my last webinar and what I'm saying now is the same. If you do not know what the future holds, which we don't, then private investors have this desire thinking, I'll ask an expert. He'll have a crystal ball and a time machine. No, we don't. What we do is we have a set of rules which we've tested in the past through these circumstances, and we just maintain that discipline. Okay? When I'm on the BBC or CNBC or Bloomberg, I might talk macroeconomics because that's what they've asked me about. But the fact of the matter is, when I used to do my Bloomberg TV show, I'd have my laptop up and I'd say, well, I think what we've got is if it drops X%, I'd look to get out Y. That's it, 663. So it's fallen 15% since then. There you go. If it fell 10, you should have exited Y. I'll tell you in hindsight what the number is. Oh shit, the number was if it dropped 1%, exit 100%, clearly. Okay? In hindsight, I can tell you. In foresight, you've got to determine it on your risk appetite. Unless you think that there's an expert out there who knows the future because he has a time machine. I certainly don't. That's nothing new to what I've ever told you before. All right? How do you know somebody's telling the truth? Well, when they tell you that their degrees don't help and they don't have a time machine, and they've told you that before the market fell and after the market fell, and they're consistent about it. All right? We have a simple process. We use the process. I'm not the only one who said it. Jim Simons, the legendary hedge fund manager who generated 40% per annum after fees for the last 30 years, said, I don't have an opinion on stocks. The computer has its opinions. We follow the computer. It's the same for me. Right? So with this, I don't have an opinion on Rolls-Royce other than if it drops X, sell Y. And remember, we did this with NVIDIA. Was it last year or the year before? And we ended up staying in because it just didn't drop enough. 15, 20. By the way, I'll tell you everything I've sold, what my son is holding for the moment. And as I say, clients who are having a heart attack who might be worrying I'm trying the crown jewels, I'm really not. So don't worry. Bear markets. That should be 2022. 1 year total return post the trough. This is after it bottoms out. And I'll tell you how I determine the trough. Many of you have seen it before, and because I've said it a million times. Okay, I'll tell you how I determine the trough. I've told you this a million times on these webinars. Okay, give me 1 second. I've got the team using the same material. Okay, it's here. You take a photo of this stuff if you need, all right? The trough, as I've told you, it's a daddy bear when this falls below when the moving average, when the MACD, which is the green dotted line, falls below its moving average. Now, I've said that a billion times. That's when it's a daddy bear. Did I get out a bit too late? Yeah, I wish I got out up here. Have I been saying for too long that it looks like 2022? Okay, well, this 2021 to 2022, and that we might fall. Yeah, I've been saying it for about 6 months. Did I stay in? Yeah, because it hadn't become a daddy bear. Why didn't you get out when it was flat? Well, because it's been flat before and kept going higher. Why didn't you get out when it first dipped? Well, for the same reason I didn't get out in bloody 2022, which is I was hoping it wasn't true, and it was. Should I have got out earlier? In hindsight, yes. Did I get out as it became a daddy bear? Yup, around there. I think I was in India 3-4 weeks ago when I exited the S&P. Did I get out of all the stocks? No, I left some of them in. I should have got out. I got out of Microsoft and the S&P at the same time, but I should have got out of the other ones, which I'll tell you in a second, even sooner than I have. Why did you leave it so late? For the same reason I left it there, because one, like anybody else, I'm human and I was in denial. Maybe things will turn around. Maybe Trump will change his mind. Maybe something will cause it to bounce off its own moving average, as it so often does. But in hindsight, it was obvious nothing was ever going to come along to save the day. In hindsight, everything's obvious. So you should feel better on a couple of grounds. Even the professionals are late out. Okay, we're late out. But when we get out, that's what causes the bigger falls. So our sell orders will drag this lower. How much lower is it going to go? Well, until this happens. All right, I'm just going to leave you with that. Until that, I'm not going to finish yet. Until this happens, a flattening of the monthly, don't even think about getting in. Simple. Till the monthly MACD flattens, don't think about getting in. All right? I said it in 2022. I'm just repeating myself. You know what's going to happen after that happens? I'm going to start making some killings. Why? Well, we didn't get in there in 2022. As you know, because I've said it a million times, we didn't call the bottom. We got in 2023 on a 3 times leverage. That was 150% return there. We lost some of it as it dropped back. Fine. I'll take 150% return any day. Okay, 3 times on the leverage, and it'll be 3 times on the leverage again when I get in. I won't get in one go. I'll probably get in slowly because I won't believe the rises up either, just as I didn't believe the falls. And that's somebody with bloody experience who didn't believe it was going to happen. By the way, some of my students got out before I did. They said, as soon as you said it's flattening out, they got out. And I said, do you know what? You're better than I am. 1 year total return post-trough. tends to be this, which is what I expect to happen again. I will do 3 times average on the S&P because I'm more risk loving. When that time happens, when will that time happen? I don't know. It's not today though, is it? So I don't need to worry about it. These guys, now you keep getting on social media, people going, oh my God, Warren Buffett's a genius. He sold all his S&P. He didn't have any bloody S&P to sell. These are his top 10 holdings. So don't tell me he sold £5 million he sold, you're right, he sold 0.00, I did the maths, 0.00004%. He didn't sell it. It's an automatic rebalancing system that they have. Oh, he sold his Apple. He's so clever. No, he didn't. He sold some of it. He's got kept more than he sold. He's got 70 billion in Apple. Goldman Sachs have got that. Now, I've sold all of mine because when this daddy bear happened, that's my last opportunity to stay in the quality 5. So as soon as that daddy bear happened, okay, I had to get out of all the quality 5, the 2Ms and the 3As, Meta, Microsoft, Apple, Amazon, Alphabet. There'll come a time when I will again make the same returns on them that we did. I'll show you something else that we did in 2023. And it might take a year. I don't know when it'll be, but I'm not worried because when that happened, which I've told you many a time, okay, that 341% is going to happen again. Leverage it, 700% will happen again. I don't know when. Because the reason we follow this daddy bear rule, you can see it there, is because we're trying to avoid that. Now, let's get something straight that I have said before over and over again. I did not know 2022 was going to be a down year. I didn't know this was going to be a down year. Got it? The computer told me, you've got to get out now. I did not know, for instance, Meta was going to fall 62% in 2022. If I did, I would have gone to Ladbrokes. Have you heard me say that a billion times before? Yeah. Okay. All I knew is the computer said you got to get out, so I got out. That was it. The computer didn't tell me it's going to fall 62%, so I didn't go to Ladbrokes. I didn't know in 2023 it was going to go up so much. All the computer said is you can get in now. It's okay. That was it. Right? Those subtle nuances are important. What I'm trying to tell you is I know less than you think. I've always told you I know less than you think, but it makes me money for the simple reason I know less than people think I know. I follow the simple rules. There are times to stay out. There are times to get in. And even sometimes when you think it's time to get in, the bloody thing falls anyway, okay? It's not guaranteed for the future. So that's where we are. I'll answer your questions in a second. I'm sure there are some questions after such. Daddy bear, is that like a big or sudden downtick? No, the daddy bear. This is publicly available. How could you not know that? It's on my blog. I blogged it years ago. alpeshpatel. Oh, sorry. The blog is campaignforamillion.com blog. You'll have to scroll down. There's a picture somewhere of a bear. It's on here. Where is it? You don't follow my blogs? Now, again, some of my clients, well, 2 of my clients, there's only 2 of them who ever complain, are going to go, oh my God, you've written all this. I've written 18 books, guys. Somewhere on here, it'll talk about the daddy bear. It's on the blog. I will put that in the chat. I think I can put that in the chat. Yeah, the link to the blog. Okay. So it's there. That's where it is. I've written about it donkeys ago. I just followed that rule. Well, I could have been on sort of sleeping and it wouldn't have mattered. Oh, I'll tell you what. Control F, Goldilocks. I called it Goldilocks, if I can find it. I write so many columns. I think there were 4 this past week. But yeah, if you scroll down, you'll find it. I'm going to find it for you in a second. Oh, yeah, Goldilocks strategy. Found it. I'll give you this straight away. It's quite low down, actually. I've done about 100 articles since then. It was written a year ago. A year ago, I wrote the article. Why did I write a year ago? Well, because for over a year now, we've been somewhat overbought. I didn't know when it was going to fall, but I knew that's going to be bloody helpful when we do. And even then I got out late because even I didn't believe it or was praying it wasn't true. Keith, you've asked a great question. If you're in now, well, it's a bit bloody late now, but I'll tell you the answer to that because that needs a well thought out question. Answer. Sorry, it sounded disrespectful. I don't mean to, but I'll tell you in a second because there are some positions I still hold. Okay, so I will tell you that properly because I know a lot of you are still in. So just as a repeat, the daddy bear was there. It's just the crossing of the monthly MACD. Let me just move it so you can see it. It's in that article, which is there below there. Again, for my students having a heart attack who are saying, why are you revealing all of this? It's in my 18 books. I first wrote about it 30 years ago. And I said, as good as any narrative reading of macroeconomics, speaking as somebody with a bloody degree in politics and economics, this is more accurate than narrative reading of the news and stories. Okay, just average prices. It's not guaranteed. So sometimes foolish people who can't think straight say, well, it doesn't work all the time, so it shouldn't work any time, so I won't use it. The biggest problem is people don't know how to think, usually, rather than, just don't have logic. Okay, so did I call the bottom in 2022? I've told you before. No, I didn't. Was I in late? Yeah, about 4 months late after the bottom. The bottom was there. It was in January. I've told you before. I'm not just bidding up my own book. Did I call the top here? No, I didn't. All I kept saying was, look, it looks like 2022 is going to happen again. I don't know when. I don't know when. I thought it was going to happen here, and it didn't. It just kept going up. It just kept going up. Then when it fell, I should have got out maybe 2 or 3 weeks earlier. But this was the fastest fall we've seen in a long time, and I was still in denial. So got out too late out of the S&P and the leverage, and Microsoft at the same time. Microsoft was an easy one where I really, as you all know, I said, look, it looks like a daddy bear. I'm not getting out because I think it'll go up because nobody else is showing a daddy bear. Obviously, it just was the canary, and I should have just followed the rules. Even I don't follow the rules as quickly as I should. I'm going to come to each of those in just a second. Am I sleeping easy at night? I am, actually, except I was 2 weeks in India, 1 week in London, and a week in the United States. So I'm actually not sleeping easy at night, with nothing to do with the markets, everything to do with having buggered up my sleep schedule, which is really annoying at the moment. And I have a habit of not drinking enough water. Nvidia is only, you're paying $16 for every dollar of future profit. That's probably the lowest it's been for a hell of a long time. Am I in it yet? No. Did I sell out of it? Yes, because it was a daddy bear, as I'll show you in a second. So I had to take the profits on it. But has it saved clients a lot of money, me telling them that when I was in India and doing the broadcast for clients? Yeah, it saved them a load of money, and I've got a load of nice emails from them. The clients who didn't listen, actually, sorry, there was one client in particular who joined and didn't have an onboarding call, and then didn't listen to what overbought means or anything, ended up getting in at the top of the market before even joining the program, and then didn't listen as to what any of this means, just rushed in, bull in a china shop, and is now in the position you're talking about, Keith, which is what do you do when you're already in and you haven't reacted. So when these things are overbought, the danger is always, and overbought, by the way, means if that's top and that's bottom, it just means it's near the historic highs it's been before. Okay, that's all it means. There's a danger it could fall off. So if you're risk loving, you would still buy because you're risk loving. If you're risk averse, you wouldn't because you're risk averse. And if you're risk neutral, you might edge in cautiously, always aware that it could be like 2022 and fall off. Okay, it doesn't apply to all stocks at all. Only applies to exchange traded funds, because they have smoother trends, like the S&P 500, and it applies to what I call my quality 5, but I'll come to that again later. Now, these remain cheap. These are cheap. Now, don't make the mistake of trying to get a dopamine hit and say, I need to be back in the market. Let me go into consumer defensive and these really expensive ones. Oh, let me go into healthcare because they're doing okay. Don't chase the market, right? There's a lot of money to be made by sitting on your hands. Not doing anything is a decision. This is what private investors have a problem with as well. They're addicted to gambling. They're addicted to dopamine hits, and they're going to ruin themselves. If you don't believe me, just ask a spread betting firm how they become a billionaire. I spoke to Peter Cruddas when he set up CMC and he had 4 employees. And then I went to his office when he had a private jet. And the point is, private investors make people like him billionaires because private investors have a tendency to want to gamble. They're insane, in my experience, many of them, not all of them. I'll put that to one side. Let's show this. So earnings are coming out. We're now in earnings season on top of everything else. And I'll tell you what all these companies are going to be saying, and which is going to knock their share prices. Every one of them is going to say, we've got an uncertain outlook. We think profits could be hit, and therefore their share prices will fall. And I'll tell you why they're going to say that. Because if you say it as a chief executive of a company with everybody else who's also saying it, nobody blames you. And when you knock the share price down, you then go to the remuneration committee and you say, if I can make the price go up 50% in the next 2 years, can I have a massive $500 million bonus or some shit? Okay. And the RemCom says, yeah, okay, mate. Right. So that's how it works. So at the moment, every single one of these banks is going to want its share price to get hit because it knows we're in company. Now's the time to take the rubbish out. Okay. We're not going to get blamed for it. Even if it's got nothing to do with Trump tariffs, even if they just had shit earnings, now's the time to say, yeah, the outlook's a bit bad. We've got to really manage your expectations lower. The beauty of that is, unless expectations are managed lower, you can't have a low enough bar to exceed expectations and stock prices to rise and become like 2023 and shoot up again. Okay. Now, I said this time and again, including 25 years ago on my Bloomberg TV show when we had the dot-com bubble. So all of this is a repeat of the past. It helps when you're as old as I am because you've seen it all before. Okay. So going back to the S&P, until they smack down the expectations of prices, this can't start rising. Now, two things are going to happen which are going to catch private investors out. And I'm warning you now, this is going to happen. And when it does, in a few months, you're going to come back and you're going to say, bloody hell, Alpesh, how did you know? Well, experience and fucking grey hair, mate. One, you're going to get a rally like this, which is going to be prolonged. It's going to be pronounced. And a load of people want to get in and go, this is it. We're here. We're at the party. And they're going to get suckered in. That's called a bear trap. How will I know it's a bullshit bear trap? Because this will be falling. I said it then. I said it in 2007. I said it in 2001. I said it in 2000. I've been saying it. It's in there. And in 17 of my other books. So it's nothing new. And in my Financial Times columns. Okay. So that'll be the first mistake private investors are going to make. And then when it drops, they're going to absolutely be in nappies. Because they're going to need it, because they're going to go, oh my God, it's even lower than I thought. I'd lost this much. I got back in. Now I've gone and lost a load more. And then they're going to try and catch the bottom. They're going to get messed up. Then the next mistake they're going to make is when they exit at the bottom, when this actually does rise, they're going to say, now the market's crying wolf. And then they're just going to miss this rally until it probably goes, miss a whole year of it or so. Okay? That's what's going to happen. That's what's going to happen. Guaranteed. Guaranteed. Okay. I'm going to answer all your questions because some important ones. Thomas, Raheem, and some of you others, Jeff and everyone else. All of those are going to get answered. Okay. Because I know it's a serious time for people. This is not like a normal webinar. This is a really serious one. So that beware of, but that's in the future and I'll probably keep covering it. All right. Now, all of these are coming out. None of them, I can tell you in advance, are going to excite me. I'm not going to be buying any of them because I'm not going to be fooled into any rallies because that is the case, just like it was there. So I am already counting my future profits because I know when that bottoms out, we go again, and I'm going to pick the companies which will give me, if they hit their all-time high and they're like my quality 5 and I can get a 100% return, they're the ones. And like I said, if it takes 3 years, that's 26% per annum. If it takes 2 years, that's over 40% per annum. And if it takes 5 years, hey, that's still 15% per annum. And some of them will take 5 years, some will take 2, some will take 3. It's fine, all of it together. But we're in that mindset now because that's where we are. It's back to 2022. Did I think this was going to be a down year? No. Let me tell you and say that again. No. Wait a minute, Alpesh, review. So one of the somebody had emailed, one of the clients, well, all your degrees in economics, shouldn't you have foreseen it? And I said, well, with your ability to hear, have you never heard me say repeatedly, economics has got nothing to do with forecasting stock market? As the Queen said to a bunch of economists after the financial crisis at the London School of Economics, how come none of you saw it coming? Because I didn't, by the way. All right. We had proof that economics has got nothing to do with it because they didn't see the financial bloody crisis coming. The only people who saw this coming, the only people were the ones who say every single sodding year, we're going to get a crash. We're going to get a crash. Now, some people make a living out of that, like Jeremy Grantham. He'll say it every year, we're going to get a crash. We're going to get a crash. We're going to get Michael Burry. We're going to go crash. We're going to get a crash. They're the only ones who saw it coming, but they just say it every year anyway, like a broken record. They don't even know they're saying it. These ETFs I'm not in, they have the simple problem that whilst so I'm not giving anything away to, again, I've got to keep saying this for my two clients who get upset. I'm not giving anything away because I'm not in these at the moment. And I'll tell you why I'm not in any of these at the moment, though in the future they might be useful to look at. First of all, whilst they were up over 20% or thereabouts last year, whilst they doubled your money over the last 5 years, whilst they didn't fall as far as the S&P in 2022, whilst all those things are true, and whilst they're incredibly low volatility at only 4%, and even over the past month have been up, and 3 months, every single one of them is either overbought or falling. And let me show you what I mean. If you take the MSCI World Index, some people go, oh, just buy the World Index, you'll be all right. Well, that's how much it's fallen. Now, I know that will go from 3,000 to 3,600 again and give me a 20% return guaranteed. But I'd rather be greedy and wait for this daddy bear to finish. The daddy bear rule applies to ETFs. Okay, when that is, my clients will be told. They'll be told first. They'll be shown first. Okay, but it's not now because we know there's drawdown dangers and durations, drawdown depth and durations. And this could be a 2-year duration. Luckily, we've got more options than just this alone. But that's why none of these at the moment I would be in, because they all look like this. And I could just buy it back cheaper later. I'll still answer your question. Well, what do you do if you're in and you haven't got out? I'll answer that because that's more a technical, difficult question. Okay? On that. Now, like this one. Quality dividend. These are the ones which doubled your money over the last 5 years and probably will over the next 5. Were up last year, at least 20% return. Didn't even fall as far as the S&P, right? But I wouldn't buy it now because look at the size of that fall, exactly like COVID. Now, drawdown depth and duration to recovery tends to be small and short in ETFs, small and short, small and short. See, small and short. However, I don't try and bottom fish and pick the exact bottom. I would wait. And given that that's still a daddy bear, like this scenario here or like that scenario, I will wait, and I'd rather get in late here than try and get in at the bottom here and be greedy, just in case it keeps falling. Okay? So, whilst in the future that might well be in my portfolio, it won't be today, won't be at the moment, might be at some time in the future, right? Now, again, for my two clients who get upset and have a heart attack at this, that's a bit like me saying, I know, one day I'm going to buy some stocks, all right? Because I know I'm going to have to wipe away their salted tears later, why I've done this video. Minimum volatility, S&P 500, same issue, minimum volatility. Yet, drawdown depth and duration, we've seen it before. COVID was worse when we thought the economy had broken. It's amazing to me how many people think that I've forgotten COVID. Okay, 54% think the S&P will be, the FTSE will be high by the end of the year. Interesting. Let's see how many of you think with the US markets. Well, let's say the Dow. Okay, I'll just publish that one. Now, okay. So I wouldn't do it now because I certainly wouldn't do it whilst that's falling. Very simple rules. Very simple rules. My industry is full of people who have very simple rules. It's the simple rules that make us money. Now, am I going to continue with stocks to use these rules? Yes, we're still going to look for stocks which tick those boxes. But am I going to buy anything now? No, because we have a simple rule. I am not going to be buying stuff when there's a daddy bear. So 2022, most of the year, I was like, sorry, we've got to wait. We've got to wait. We've got to wait. And by waiting and keeping tons of dry powder, we get our 100% gainers. Okay? Delayed gratification. That's all it is. And there's nothing wrong with it. Delayed gratification. Okay? So even if all that's all green in any stock, it's not something I'm getting excited about. Which stocks are above 0%? Well, there's a few. As you can see, most are underwater. There we go. Most are underwater. Good. Because some of these are going to bubble up. Certainly the safer names. And that's where the 100% gains come. And it's the 100% gains I'll want. As long as they're in the ones I got them in before in 2022, which were the likes of Meta, Microsoft, Apple, Amazon, Alphabet. But don't do it today. You could easily see yourself lose another 50%. That's the past week. Now, in the past, as I've often said, when your wealth manager at St. James's Place or Fundsmith or whatever And by the way, they're going to speak to them. They're going to say, oh, no, just hold on, keep losing money. They're going to do what they did in 2022. I'm going to show you what they did in 2022. They're about to kill you, okay? Because they'll never tell you to go into cash. So in 2022, when Meta was falling and Scottish Investment Trust lost 50%, it's going to lose another 50. When Fundsmith had crappy performance, it's going to happen again because it won't hold cash because they can't charge you fees. When St. James's Place keep telling you to buy different things and all the rest of it, and they'll never tell you to go into cash despite that bleeding happening. And the problem with that isn't that, oh, well, it recovers, Alpesh. Look, it was fine. It was all well and good. Look, you just recovered. Yeah, no, the reason we have the daddy bear rule, okay, it's very simple. It's not because if things don't recover. It's because I don't want to have the bloody 70% heart attack. I've done this video before. I've done it over the last 3 years. If you remember my videos, you've seen this. It's on YouTube as well. And I don't want to miss out on the doubling your money during that same period. Look at that. That was 100%. We got in late, and that's just up to the break-even point from exiting, right? So they get 0% over 2 years. We get 100% over 2 years. What's 100% over 2 years? 40% per annum. All right? That's why we have the daddy bear rule. I'm just consistently saying what I've always said. I've not changed the rules on anything. I've not said anything different to what I've been saying on video after video after video after video for 2-3 years. Now, here's another thing they'll tell you, and this is how you know they're idiots. They'll say to you, we've got to diversify. Really, what should we diversify into? Maybe some consumer defensives because we can find a new way of losing money. Oh, let's diversify our NVIDIA by buying some, let me see, PG. Well, that hasn't helped. Everything's bloody down. Well, let's pile into United Healthcare. Fine, United Healthcare is the only one. By the way, in 2022, the only one which was green was Eli Lilly. And I said to people then, Eli Lilly's going up, I'm not going to go in because I haven't got the kahunas when everything else is on fire to think that my little square of green is not going to catch fire. And guess what? Eli Lilly went up the whole year and I wasn't in. So what? So what? I didn't make that money. So what? I just stayed in cash. So what? That's all red. So you tell them, wait a minute, I thought diversification meant everything didn't fall. Some things were diversified. No, they're idiots. There's correlation to the downside between silicon chip manufacturers and real estate. When the markets fall, there's correlation to the downside. That's very simple mathematics. It's a very simple truism of the market for anybody who's got half a brain cell. Your average IFA, actually, no, not your average IFA. No single IFA has half a brain cell to know that. Not one, because their textbooks are wrong. Their textbooks are wrong because they were written in the 1960s when the world didn't have the internet and interconnectivity. If you don't think the world's interconnected, that's why people are wearing nappies about tariffs, because the world's interconnected. Nobody would care about tariffs if it was 1960 because you're hardly doing any international trade anyway. All right? So that's that. What is happening is overreaction in some quality companies. When will that end? We don't know. When will it be time to get in? I told you, when the daddy bear's over is the first time I'll start looking at it. Tesla over the past year is up 34%, very volatile, I wouldn't do it. Nvidia's up 9% over the past year. How quickly? There was me, this close to buying an island in the Bahamas just off Nvidia profits. Now I've got to buy an island on the Thames. My point being, this was fast, how quickly it retreated. And don't count your money until you've sold the damn thing, not when you're looking at it, all right? People listen more when the markets are falling. Palantir is still up 236%, but overbought. Berkshire's up 17, JP Morgan 8. Okay, so and I think I said it in one of my public broadcasts, when I got out of Goldman Sachs and JP Morgan, because 12 months were coming up, it had fallen X% off its highs, blah, blah, blah. What I hadn't realized is that my son's junior ISA and my wife's ISA still had JP Morgan and Goldman Sachs in there. I'd forgotten I'd put it in there. And I've kept it. Why have I kept it? I'm going to keep it for 5 years in there because I can't be bothered bureaucratically changing their portfolio. Theirs is really long-term 5-year holds. I have no problems, as I've occasionally done in the past, some stocks just holding longer term for 5 years. Now you might say, well, why don't you do that with all of them, including Meta? Well, the reason I don't do it with the likes of Meta is And why at that investor conference, the hedge fund manager said, I've got out of the Mag 7, including Meta, but I can't wait to get back in, is because I want to avoid that drop and get back in. This is a good extreme example. How many of you have seen this same bit that I've made this point before for about 100 times over the last 2 years since the crash of 2022? Anyway, but Goldman Sachs, and those I've kept in theirs because I don't want to change theirs all the time. It's 50% because I can't be bothered changing their portfolio, the frequency with which I do mine. I only want to watch mine. And secondly, because I want to show people out there, there's nothing wrong with holding things longer term. You might get slightly lower returns if you hold this without following the daddy bear rule. And if you follow the daddy bear rule, you'll probably get slightly better returns. That's it. Okay. And they can get lower returns. My son's 7. The bugger's going to get lower returns. So what? He's got enough money. Right. So let's break this down. Year-to-date performance. Year-to-date, 45% down on Tesla. Nvidia's down. I won't buy that yet. I won't buy any of these yet. Not until the daddy bear's over on the S&P. Not least because these feed into the S&P. Okay. Broadcom. Beautiful, 32% down. You know what that means? Do you know what 32% down on Broadcom means? It means I'm going to make a 50% return when this goes back to all-time highs. The question is, if it takes a year, that's 50% in a year. If it takes 2 years, that's roughly 20% per annum. If it takes 3, it gets me down to about 13% per annum. Ouch. I don't think it'll take 3 years. I'm not getting it yet. Not yet. Not until, like I said, the daddy bear's over. Elevance suddenly, this is so annoying. Elevance was one of my picks from last year, which didn't do that well because the market was just screwed companies like Elevance and CVS. All of a sudden, the market's changed its bloody mind. They're doing incredibly well. An argument for some of you saying, do you know what, Alpesh? I think I prefer the 5-year thing. I know when I look at Meta, it might take longer, but I'd rather have that in some of these than just the 1 year daddy bear in and out. Okay. Others will say, I don't want individual stocks, too volatile. I'll just have the ETFs. But I appreciate what you said about ETFs. Don't do them at the moment because the volatility. Somebody had asked about inverse. I don't do that or teach that only because you can really get your fingers burnt. And most of my audience are in pensions. So whilst the inverse go up when the market falls, I don't. Just like with leverage, I say, look, don't do leverage, even if I do it myself. I don't do inverse ETFs. I've never bought an inverse ETFs. If I want to hedge or trade I'm net short, but that's purely on CFDs and spread bets. And that's not appropriate for this audience or this discussion about momentum. So I'm not going to even discuss it. And it's completely different to pensions. It's trading and it's high risk trading. It's not for this audience. So I'm not going to discuss that. Okay. But where's your diversification? Ask your IFA wealth manager, oh, well, I think we should have a bit of money in China. Really? What? For diversification? Where is it? When the markets fall, the way to diversify and remove market risk is not be in the market, i.e. remove the market out of your portfolio. They won't ever tell you that. They won't ever do that. They didn't do it in 2022. We picked up a bucket load of clients because they realized, oh, shit, you're right, Alpesh. They never do that. They've got a conflict of interest. Okay? And they won't be doing it again. And just watch your Scottish Investment Trust and all your ones fall because they've not told you to be in cash. This time, unlike 2022, I'm going to be really aggressive and tell people, just watch it bleed away because they won't ever tell you to hold cash. Don't do this. This is short. It was just to show you the Russell 2000 fell, and that's why the shorts are working. These can really pull back sharply. You can lose. Because some idiot somewhere is going to show you this, and I'm telling you now, don't do it because you can lose 50% of your money in in a month. You could 2 months, you could lose 50% of your money. So that's what I wanted to show you because I knew somebody's going to ask me, what about shorting? Okay, this is ultra short, leveraged. If you want to gamble, you better be skilled at it. So don't do the shorts. Markets year to date, yuck. Okay, well, yeah, I know. Should have got out sooner when the daddy bear looked like it was going to happen. And people said, looks like it's going to happen, Alpesh. Why didn't you get out? And I said, well, looks like it doesn't mean it has. And of course it did. John, you can watch this again. I'll post a replay. Markets 1 year, it's this. Which doesn't look too bad over a year. You just think, oh, okay, pretty flat. Oops. P ratios, average over 1 year has been 31. We're at 25, so you're paying $25 for every future dollar of profits. Profits are going to be hit. So whilst they've increased 12%, that'll probably come down a little bit. Market capitalization's already dropped in anticipation of what's going to happen. Price earnings ratios by these sectors. I'm not taking anything out of these. I don't do top down. I do bottom up with individual stocks. I don't care that all this has been forecasted as growth. United Health is a good safety one, but I'm not holding it or buying it at the moment. Okay. I'll come and answer that question in a second, that complicated one. What do you do if you haven't? Okay. Price to earnings ratio 16. So all of those you are still holding, I'll tell you, the clients get the information first a few weeks ago, but they get pissed off if I tell the public too early. That's UK, doesn't matter. That's UK, doesn't really matter. You can have a look at that, take a photo. It's also UK, doesn't matter. Not getting into any of that. These are some of the ETFs, which again, they are all either overbought or in daddy bear. So not for me, thank you very much, including gold. It's overbought. In any event, like I told you in December, my wife bought some gold coins, not an ETF. She doesn't know ETFs. And she looks a genius. By the way, it was nothing to do with me. There's somebody we know, a family friend, who watches gold like a hawk. And he said, buy gold coins. And she said, okay. And she bought some gold coins. So she's done rather well since December. I've mentioned this before. The gold keep going higher. So today she looks clever. She is actually very clever. S&P 500. Okay, so there you go. There's the daddy bear. I show this every week when I do the weekly updates, or when I do the weekly updates, and it's just a repetition of that. When it was rising here, I said it was like this. Be careful. When it fell, I was in denial. This is the bit where I was in denial. No, please don't let it drop. And you might say, well, you idiot. Everybody knew. Look at Trump. It was bound to fall. Well, yeah, you're braver than me. I just didn't want to. And then before it crossed, if you remember, I got out because I thought, yeah, I think now I just better take some money off the table and then save myself the bigger falls, thankfully. And got out of all the leverage at the same time, obviously, because leverage definitely, and on the quality 5. You don't want to be having leverage, and I'll show you why. NASDAQ hasn't quite got into a daddy bear, but I got out of that at the same time as the S&P because I just need to take money off the table then. Okay, the FTSE 100, well, that has dropped off and has become a daddy bear itself as well. So for those who want to be in it, not that I am, but if anybody is, you shouldn't be now. This is what leverage looks like, and that's why you really want to be out of the leverage, because look, from 2,500 to 1,750, 33% drop straight away. 33%, and you didn't even see it. That's why leverage is only for those who constantly watch, and you go by the underlying. So we had to get out of our leverage, and that's just 2 times, a lot sooner. Don't use leverage and then don't look at the bloody markets, okay? Microsoft should have got out earlier when it was the daddy bear here, because that's the rule. Guess what? I didn't, because I could have got out. And I even said to you, if you remember at the time, saying, I bet I'm going to regret it. It's at 2,000. Some of you are going to go, when it goes low, you idiot. Well, you could. So got out once the underlying became clear it was dropping. So missed a bit, but there you go. Amazon had to get out at the same time as the underlying became a daddy bear. And of course, Apple, they're all daddy bears. Somebody said, what if you haven't got out? Not of this, but of anything. Well, the danger is if you haven't got out, it's very simple what the danger is. So let's say you haven't got out. Let's go back to here. Let's actually go back to what happened. So let's say it was a daddy bear and you didn't get out. Well, the danger is not a danger. You should be prepared for a 70% drop. Okay, depending on the stock. Just look at what it did in 2022 and assume it's going to repeat itself. Big assumption, but it's a fair assumption. And it's going to take you, therefore, 2 years to, was that 2 years? I think it was 2 years to recover. So be prepared to lose more of your money and take a long time to make it back, which is fine. 2 years, yeah. Okay, so with the S&P, if you haven't exited, all right, your downside is it repeats what it did before. Okay, just repeats what it did before, that's all. All right. So now you know what your downside loss is going to be. Peak to trough, this was 25%. All right. So peak to trough, just assume it's going to do that again, and you're going to lose 25%. All right. And it's going to take you 2 years to recover. That's the inactive approach. Right. That's fine. That's what Warren Buffett's doing at the moment. He's incredibly exposed to the S&P. He knows this is going to happen. He doesn't care. Right. The alternative is you end up biting the bullet, but you're probably going to mess it up. So you exit now, and then you've got a time getting back in. Guess what? You might time getting back in late as well, because you exited late. You might enter late, and then you end up getting in at a higher price than if you just stayed. So for those who are late out, you're probably of the type who doesn't want to be fiddling, in which case you might as well just stay in knowing that you're going to lose a load more, but you'll make it back eventually and you'll end up 0% over 2 years. That's all. All right, that's all. So get prepared for more pain and more waiting. But the alternative to that is you take the plaster off really quickly, but if you don't get back in to make the gains, you're going to be double screwed. All right. Semiconductors I'm not in, as you know, but I show this in the weekly stock market update because it's a daddy bear, so I wouldn't want to be in. Apple, daddy bear. Had to get out. Why didn't you get out at the top here, Alpesh? Well, for the same bloody reason here and here. It kept going up, didn't it? And here, we wait until it's a daddy bear, and sometimes you end up, giving up, because we're giving up a bit. I've even said, I think in previous webinars, I've said, let me know if you've got a better way, like witchcraft, for calling market tops. We don't call market tops. Amazon, told you I'm not as clever as you think, but it works. Amazon, well, when the S&P went into daddy bear, I didn't wait for this to go in. I had to get out. Alphabet, daddy bear. Of course, what I should have done, in hindsight, is when Microsoft became a daddy bear, got out of all of them. Occidental, now here's an interesting one. Remember last week, I think it was last week or the week before, I said, I think it might have bottomed. Warren Buffett's got a load of these, but I'm not getting in because that's still falling. So wait. Bloody hell, did it fall off? Now, there'll come a time to get into this. It'll be when it looks like this, that pattern there. And that's when it's going to do this. Now, it's going to do it at some point. Hopefully, it'll drop to 28 and I'll triple my money, but it's not going to be today. People who can't listen properly will start buying this today. Don't be stupid, okay? What do I do with my portfolio? Watch Alpesh's weekly update. Hold, do nothing. If you want to hold and do nothing, that's up to you. That's fine for 5 years, but just know, quieter life. Okay, where am I at the moment on all of this? I'm at wait a month. Why? Very simple. If it's a daddy bear, it's wait a month, or if the MACD monthly is falling on the S&P, it's wait a month. If it's going sideways or rising in an overbought, it's this. And if it's oversold and rising, then it's this. Where are we at the moment? This. Everything I say has a mental algorithm behind it to keep things simple, because I am a very simple person. So whilst I got out of this on mine because of the falls, if it drops X, sell Y, and 12 months were up, and we pocketed profits, I'd forgotten my son and my wife had it, and I've kept it in theirs for 5 years. Microsoft, daddy bear. So what should Alpesh have done? See when that happened, which was here, which was really near the high. I should have got out then. That's called hindsight. I didn't even get out when it was a daddy bear in January. I pointed it out to you. If you listen to my webinars, you'll say, oh my God, it's a daddy bear. I need to get out, but nothing else was. So I stayed in. Idiot. Should have got out. Because when I did get out, when it became clear the others were all becoming daddy bears, it kept falling. That's fine. When it does this, we'll make our 100% return, and I'll do 2 times leverage and make my 200% return in it. So we had profits from 2023, which got pocketed a little bit less than I thought. We gave up that much in profits. We made that much in profits from 2023. As you know, I've held it from 2023. I've been bloody telling you. Okay. We gave up a bit. So what did we give up? We gave up that much. And we gained that much. Okay. Well, double all of that, because there's double leverage in those as well. NVIDIA, similarly, daddy bear, have to get out. Now, notice how, when was it? I think it was, this period. I thought it was going to be then we'd have to get out, but it didn't happen. It didn't cross, so we held and held. And if you remember watching my webinars at that point, me saying, I think NVIDIA is going to fall. I think NVIDIA is going to fall. It's overbought. I think it's going to fall. It's going to fall. But it never did this, what it's just done. Because it's done that, I've got to get out. Now, for all I know, that's the market bottom. I don't know. Or it might do this and go from, God, I hope it does that, go from 30 to 10, because that allowed me to triple my money. I don't do leverage on, I haven't done leverage on NVIDIA, but I might going forward. Certainly if it falls a similar amount to what it did then. But we'll wait for the daddy bear to be over. Meta, out with all the rest of them. Eli, daddy bear, so I'll wait, and then in due course make 100%. If 100% is over 2 years, it's 40% per annum. If it's over 3, it'll be 27% per annum. If it's 5 years, it'll be 15% per annum. Broadcom, similar kind of story. Okay, now it's getting all the same. Goldman Sachs, son and wife still have it. It might drop loads. Why did I keep it in there? Well, I wanted to prove the point to people. There's nothing wrong with holding some stocks for 5 years. I don't just want to, especially if it reduces bureaucracy for a 7-year-old child, my son. Taiwan Semi, same as all the rest of them. There'll be a time to get in, but now's not the day. United Health. Now, United Health is one of those, like Eli Lilly, like I said, it's a safe haven. I will, in hindsight, say to you, wish I did get in, but I don't want to. I don't want to at the moment. I just don't want to in this market. Although it might do well. Like Eli Lilly did that, yeah. Probably I should put everything in there and nothing else. Write that down. Alpesh said, April 9th, put everything in United Health and nothing else for the next 6 months. I'm not going to. But I bet it's up in 6 months. Tesla, very volatile. What do you want to know? It's freaking volatile. Stay away from it. Lam Research will at some future stage do this, and we will go from 38 to 100, which is basically double your money. Not yet. Not yet. Novo Nordisk, not yet. That little baby is going to fall, and then I'll get in. I'll get in late. I always get in late. I never get in on the down. Okay, unless it's purely by mistake. I always get in a bit late. So when the prices move like this, me, Winton Capital, and other multi-billion-dollar hedge funds get in there. We don't get in at the bottom because we don't have witchcraft, and we certainly don't get in while it's bloody falling because the odds are it'll continue falling, and that's also continue falling. This at least gives us a 50-50 chance, okay, whereas this gives us a 66% chance of losing money. It's very simple maths. Visa, no, not yet. There will come a time. I've got a suspicion a lot of people are going to be starting putting... by the way, this point on iPhones, putting money on their credit cards in America. This thing on iPhones, you know, British iPhones aren't going to get more expensive, don't you? Unless they spread the cost amongst their global companies and reduce the cost to the Americans and cross-subsidize. Do you see what I mean? So it's only the American ones who've got tariffs from China. Britain hasn't got tariffs from China. America has. Okay, so British iPhones should cost the same unless Apple says we'll increase the price of all our iPhone sales around the world and cross-subsidize the Americans for demand management. Anyway, all of that means nothing. All it means is when we're out of a daddy bear, we will start buying Apple and doing 2 times leverage on it, and Visa. So what are the quality 5, which I've mentioned many times before? Okay, it is this. 27% per annum. If we didn't use the daddy bear rule, if we don't use the daddy bear rule, it's 27% per annum. This is what it looks like. If we don't use the daddy bear rule, these are the returns on the quality 5, the 2Ms and the 3As. If we don't use the daddy bear rule, why do we use the daddy bear rule? To try and avoid as much of this as possible. Okay, that's why. That's the only reason. That's all. That's all. And that's the monthly stuff. You don't care. We're just trying to avoid some of this. We can't avoid this. We didn't avoid this. December 2018. We didn't avoid that. 2020, we didn't avoid that. We're just trying to avoid the worst parts of this. And we've avoided a lot of this so far, which is a bloody miracle. Actually, I think we've got out, in the end of things, I think we got out sooner here than we did. No. We got out sooner in 2022. We got out right at the start of the year because it was this bit I think we got out on. It was like -4 or something. So yeah, we avoided all of that. Here we've got out later, actually, technically. We're just trying to avoid this underwater period of being in negative returns for 1 year, 7 months. That's what the daddy bear does. It avoids that. But it didn't avoid any of these. It did not avoid any of these. Okay, just so you know. So there were months, we were 7 months underwater. Peak to trough, it had fallen. We were 3 months, 4 months. Okay. That was them. Just some numbers. That was last year. Now, if last year was April to April, it wouldn't look like 41 bloody %. You can see why I really needed and wanted to take the profits on these, although Goldman Sachs is still in my son's portfolio. That was last year. It just so coincidentally makes me look good because last year was January to December and not April to April. Because April to April, as you saw, wouldn't have looked anywhere near as good. Okay, we don't have to be smarter than the rest. We have to be more disciplined. That's all it is. Guess what I can guarantee you? Private investors will not be disciplined. Alpesh, could we go in a 10-year period where markets just range, no significant gains are made? We could have anything. We could have anything. But it hasn't happened before, and it's highly unlikely. Harpreet, what about partially getting out? You could. You're still taking losses, but you could. It's slightly more complicated, but you could sort of partially get out. Do you think the 2-year rule applies given we're being told? Wait for dead cat. Jag, that's up to you. Catching a falling knife still. I don't wait for dead. I mean, Paresh prefers that dead cat bounce thing, not me. So we're still going to look at these, but whilst there's a daddy bear, we're not looking to get into anything. This is from Goldman Sachs. Goals. Normally, not at the moment, you'd have 20 to 40 stocks. Okay, have a look at that for a load of books and free resources as well. I've got a load of questions to ask. I'm going to be doing a broadcast for clients on which hedge funds which generate 40% per annum, what they're holding at the moment. Not that I'm going to be buying any of their stuff, but it'd be interesting to see what they're still holding because they're about to get whacked because they too will not go entirely into cash. I think if it takes 3 years on some of these stocks to double money, that's still 20% per annum. Over 3.8%. I think that's what we're getting closer to. That's why I'm happy to stay on the sidelines at the moment. Do you hold 2 times average for years at a time, such as well, as you know, well, it was 3 times. The 2 times I only did belatedly last year. The 3 times I'd held since January of 2023. Look at any of my old broadcasts. I do weekly broadcasts and put them on YouTube. You'll see that I've been holding 3 times S&P for donkeys. The 2-year S&P return since 950. Now, in January, people asked me, what do you think the return's going to be? I said, I don't know what it's going to be this year, but my bet is 32% over 2 years. And I still stand by it because over 2 years, historically, that's what it's done. It's going to bottom out at some point this year. And then, so I get my 32%. The only reason for the daddy bear rule is just to avoid some of this, the worst returns. That's all. It's not to avoid, it's not to call market tops and bottoms. It's not to avoid all negative returns or only ever make profits and never have losses. No, it's just to avoid some of the worst excesses. And that subtlety people don't get until they live it. Thank you. Okay, have a look at that if you wish. You know how to open SIPs and ISAs. It's the new tax year. So whether it's Barclays or whoever, just be careful of your pension funds at the moment. They won't put you into cash. Now, I said this too softly and diplomatically in 2022. Now I'm going to say it loud and clear. They're going to destroy 50% of your pension because they're going to keep you invested in the market whilst it falls, as Scottish Mortgage Investment Trust did in 2022. And the same bloody thing they're going to do again. So are Fundsmith, so are St. James's Place, so are all of them. I'm telling you now. John, dear Alpesh, I have to thank you again because thank you so much. I managed to put my daughter through university by watching your webinar. So great. Oh, thank you, John. Get in touch. I'll send you a hoodie for your daughter. God bless you. I'm so pleased. What a nice thing to say. That is amazing. Oh, private. No, mate. I've got a broadcast. I'm going to the room. Thank you, John. Hey, Alpesh, do you hold? No. So we got through that. Craig, Alpesh, some of my NASDAQ stocks dropped super quick. I know. I should have got out. I know. I was in denial for some of it. So don't worry. Am I still in denial putting a stop loss at this level? Yeah, well, what you've got is if you think they're good companies, I showed you the Meta example. Look at Meta. That's what's going to happen. They're going to drop a lot further. Then they'll rebound. It's just going to give you, it just means you're going to get 0% for a longer period of time. That's all. Okay? But you might say, well, wait a minute. Next year, I've got more capital. So I might buy at the lower price. So I won't be 0% for the whole period because I'll have bought at a lower price later anyway. But make sure they're good companies. If you want to join the program and get the hand holding, please do all of that stuff. As I say, all that is. Guess what? New tax year, markets fell. We've had a lot of people saying, bloody hell, I should have listened to you. Yeah, I think I would like to. Alpesh, would like to chat more about potentially becoming a client. I mean, obviously, yeah, just email me. Absolutely, Chetan. Just email me. I think you've all got my email address, alpesh.patel@tradermining.com. But listen what I said. As one of the clients who joined up in January said, hey, but with your economics degree, how come you didn't tell us when that the market was about to fall? I said, well, we do. It's the daddy bear rule. And as you can see in 2022 and now, it's a little bit late. Economics might get you out when the market's soaring. Economics will tell you anything you want. Shashi Alpesh says, I enjoyed you. I made a huge profit and still holding. Delighted, Shashi. Good. Just be careful of Meta, you know, that kind of thing. And follow the daddy bear rule. It's the closest thing I've got. I'm telling you as somebody with a master's degree in economics and politics, the daddy bear rule, the moving prices, is more accurate. Martin, I'm starting a new job at the end of the month, and unfortunately, they use Scottish Widows for their pension provider. That I'll transfer into a SIP as soon as I can afterwards. You could always say to Scottish Widows, until the daddy bear's over, which you can look at yourself, I want to hold cash. You can always say that to them. Do you have an idea when the market will settle? Joseph, when that daddy bear flattens out, that's when. I'll give you two examples. It's actually a really good question, my friend. One of two things are going to happen. Either it's going to be like 2022, in which case it's going to take 12 months from top to bottom, which means next February it'll have flattened out, or it'll be like COVID, in which case it'll take from peak was February to August, 6 months, 5 months, 8, 2, 6 months. It's either going to be 6 months or 12 months from the market peak. The market peak was February. So it's either going to be 6 months at the nearest to get back to all-time highs. But that doesn't tell you bottom. Bottom is about half that period. So it's either going to be 3 months to the market bottom. We are at February. Earliest market bottom is going to be March, April, May next month. That's the earliest if it's like COVID. And the latest I would estimate is going to be 12 months. Okay, for the bottom. Right? Does that make sense? Right? Hopefully that everything I've said just made sense there. Okay. Is it better to pick particular ETFs, Mohammed? Is it better to pick particular ETFs or individual stock situation like this? Neither. Hold cash is best in a situation like this. If you are more risk averse, which most people are, then you should really be holding ETFs generally anyway. I've always said exchange traded funds. It's my fault. I've under advertised exchange traded funds, but they're bloody beautiful. Thank you, Ravi, my friend. 5 years on Great Investments program has been life-changing. Alpesh mentorship and the phenomenal education provided helped me understand my risk appetite and make smarter investment decisions. It's a trillion-pound transformational journey. Thank you, my friend. Thank you so much. Who else have we got? Sashi, thank you. Chetan, thank you. Thomas, Alpesh, would you invest all or keep always some cash on the sideline? So in the most bullish market, let's say when it was like this, okay, the sweet, easy spot. Remember this period? Then I was 90% in. But this time, you and I both know this fell really sharply, a bit like COVID. There wasn't even time. You went on vacation, you came back, and bloody COVID had happened. So it's a bit almost like, it's halfway between a slow bear market and an ultra fast one. This one's sort of medium speed, right? And in that, I didn't get a chance to go from green to red through amber. It was like green to red. So I had about, I think at most 30% cash, but really I should have been taking, in hindsight, more and more cash. Okay. Does that make sense? So I was overexposed when it started falling. Yeah, I didn't call it perfectly by any means. I never do. Joseph, I wish I'd joined 5 years ago and get for almost a year now. Thank you, Joseph. God bless you, my friend. Craig, Alpesh, some of my NASDAQ stocks dropped super quick. I know. Oh, I think I answered that. Hey, Alpesh, do you hold to? I think I answered that. Guys, if there's any questions I missed, just message me. Harpreet, what was suggesting if you're still in S&P? Well, it's this. This is what's going to repeat itself. So you've got to assume if this repeats itself, are you okay holding into the falls and waiting for your recouping of your money? That's all. That's it. That's right in front of you. By the way, I've been showing this every week for donkeys anyway, so I'll keep showing it every week. Okay, guys, I better go. I think I better go. Let me know if there's other questions I should be showing you. Oh, just post the questions again if I've missed any, because I know there's a whole bunch of questions I missed. Sashi, I'm top up since last week to S&P 500, NASDAQ and others. I'm top it up. Don't top it up yet. I wouldn't. I'd follow the daddy bear rule. It's as simple as that. I am. Now, look, Sashi, I can't guarantee the future. I might be wrong. Okay? I don't think I am. I do tend to be humble in front of the market. So I'm not humble about, I don't know, quality of my Financial Times columns. I think they were really good. But when it comes before the markets, I'm humble enough to say I could be wrong. I don't think I am, but I could be. I will try and put it tonight onto YouTube, my friend Andrew. And the link will be alpeshpatel.com/latest shares. At the moment, that will point to webinar over. It will soon point to being able to see it. Been watching on the phone. Can I get? Yeah, it'll be the same link, alpeshpatel.com/latest shares. That's what it'll be shortly. Okay. Is now a good time to buy gold, or should I keep my money in a high savings interest account? Sana, personally, I can't give you individual financial advice. I'm keeping it a high interest account with Flagstone, who pick the high interest accounts. My wife bought some gold coins. My worry with gold, with all the exchange traded funds, is they're overbought or they're falling on the daddy bear. So I tend not to. Carwin, thanks for another great webinar. Always learning from you. Thank you, my friend. Narendra, great, Alpesh, keep it going strong. Thank you very much. Hope you all found this really, really helpful, because I know it's an important, serious time. So I want to take time answering it. Terry, if you are 60 and 50% in bonds with Scottish widows, would you advocate contacting them to go further into bonds or even move into cash? Bloody hell, Terry. I can't give you individual financial advice on that. But what I'd say is, look, if they're holding the bonds yield to maturity, then you'll have a guaranteed amount of income coming in. If you get out of bonds and the price of bonds has fallen, you could be taking a massive, massive hit. So don't do anything rash with bonds without really investigating it carefully. Bonds are not stocks. The problem is bond prices can fall as well. That's why a lot of people during Liz Truss lost a fortune in bonds, because they didn't realize if they hold till maturity, they get that fixed rate of interest. They're like fixed. Remember fixed term deposits. But if you exit early, the reason you get punished is because the price has fallen. But that's a mark-to-market hypothetical exit, like a stock. What's a daddy bear? Dan, the article that I've done before, where is it? Here it is. I'll send you What's a Daddy Bear. I wrote this a year ago about when to get out of the markets following the daddy bear. Can you see the comments, Dan? I've put the link to the article. Let me know if you can see it. Was answer scroll up. No, I've put it in there. Okay. Have a look at this as well. You'll like that. My campaign to teach 1 million people how to invest better. Francis, worst case, and I fully understand some people don't want to pull the trigger and get into cash. I fully understand that. It just means you'll recoup your money a bit longer. But as long as you're well informed and you know I don't need to panic. By the way, I'm going to give you a little trick for anybody who's worried. Okay, I'm going to give you a little trick. Go onto YouTube and watch Warren Buffett videos. The man has never said anything wrong in his life. If you're worried about your investments, watch Warren Buffett. If you are worried about life, listen to the Stoics or read the Stoics like Marcus Aurelius. It's very simple, two simple philosophies. And neither of them are religion-based. I mean, you go to your faith as well, whichever it might be. So she like, many thanks, Alpesh. Very insightful. You have the same name as my grandmother. So I'm hoping that was helpful and very clear and simple as well. You know, for a man who's got a degree in politics and economics, as I keep banging on about, did you notice how I never talk politics or economics to you? Because it takes somebody who knows that stuff to tell you that it's a load of crap. I mean, the degree's great. It was fun. I loved it. I enjoyed it. God bless it. You know, and it's a proper discipline, but not for investing. Seriously. So I didn't not talk about it because I don't know any of it. I know a lot of it. But like any expert, when you know your subject matter, you also know when to shut up about it because it's not relevant. So sometimes people say, oh, who does he think he is? He's always talking about, you know, his qualifications, whatever. Let's get this absolutely clear. My qualifications make absolutely zero difference to my ability to invest. Investing is very simple rules because you have to be unemotional. Okay, so recovery is 12 months if like 22 and bottom in 6 months. No. Let me say that again. Let me get that up again. Sorry, I wasn't clear. If it's like 2022, the bottom was in 12 months and the recovery took 24 months. So let me say it again. See this, recovery was 2 years, 0%, and the bottom was after 12 months, roughly. All right. It was actually after 10 months. Got it? Okay. And if it's like COVID, bottom in 3 months, recover in 6. I think it's somewhere in between. So that was 3, that was 10. 3 plus 10, 13, divide it by 2, call it 7.5 months. We'll get the bottom from February. So let's call the bottom in September. Somebody make a note of that, please. Because in case I'm luckily right, people go, you bloody genius. I'll actually know when this happens, that pattern happens. It's very simple. When that pattern happens, I'll know. And let's say we're fully recovered in, what was that, 2 years or 6 months? 24, 6, 30, 15 months. 15 months from here would take us to about May of next year. So May of next year is when we'll be back at all-time highs. Just guessing on these charts. When it does this, that's when I'll actually know when it does that. And I'll keep doing webinars anyway till then. Okay, so I hope that's clear. Look at NVIDIA and Google rallying now. Alex, you gambler. Yeah, they're rallying today, mate. Let's have a look at them. I love this. I love private investors, honestly. If you want to trade, go long NVIDIA for the next 5 minutes. See that? That's going to keep falling. See that rally? People are going to be selling into that. And that bottom is not the bottom. 86 is not the bottom in NVIDIA. All right. Would you be able to give us Mind of a Trader PDF? Sana, Mind of a Trader PDF. It's very easy. You can get it for free. Go to trading-champions.com. Jeff, let me reply. Excuse me a second. Oh, how can I do that? I don't know how to reply to you. Oh, here we go. Sorry, apologies. www. It's alpeshpatel.com. Why can't I do it? www.alpeshpatel.com/shares. There it is. Would you be able to give us Mind of a Trader? Yeah, it is. Sana, it is. I'm going to reply to you. Reply, broadcast, comment to room. Oh, question. Oh, God, I don't know how to do that. Anyway, it is on tradingchampions.com. Okay, you can download it for free there. I have got a load of stuff to give you guys. Files. Let me give you a load of files, which includes, I'll try and put Mind of a Trader in future on, actually, that's a really good point. Sana, thank you for that. I'm going to try and put that on downloadables in future. I apologize. That's a very clever idea. I don't know. I didn't think of that. Have you seen the volatility on the Dow? Yeah, mate. What do you think I do for a living? Webinars. So that will most probably continue lower. Most probably. It's all about probabilities. So do you see here? Do you see here how when this was falling, you had these times when NVIDIA just rose up really sharply from 16 to 19 and people went nuts, or here from 14 to 19? It's going to do the same. It's going to go, and there'll be a lot of hedge funds selling into this strength. They're going to be getting out of that puppy, which is 108. By the way, 87, it's a bargain. I mean, you don't have to time it right. I'm just saying I might be able to pick it up at 61, hopefully. We shall see. I might be wrong. That might be the bottom. We might have seen the bottom already of the market right now. As a hedge fund manager said at the US event, a friend of mine, Shah, he said, look, I might be wrong. Today might be the bottom. It wasn't, and he didn't believe it was going to be, and he was right. Tariffs on hold for certain countries. Great. You know, he's really going to mess people around. Dow surges 1,800 points after a 90-day pause on tariffs. Yeah, he signals it. By the way, I'm not working. Trump announced his 90-day tariff pause for at least some countries. Fine. For some companies. Great. I don't think that's the bottom of the market. That's the jubilation for the market before the trend and the momentum continues lower, is what I think. Now, I don't think that. By the way, that's got nothing to do with my analysis of Donald Trump or macroeconomics, just so you know, and you should be worried if it did, because you know how erratic that is. It is simply a look at what keeps happening in the past. See those jumps? Even this. If that momentum is going down, there's still a load of people, and that happens time and time again. Now, you might say, no, Alpesh, we've hit the bottom. Look, we're about to turn around. Fine. If we turn around and cross above, then I'll say, yeah, we hit the bottom. But until that happens, I can't call it. I don't want to call it in advance. I don't want to call this is the bottom based on his announcements. I hope, well, actually, no, I don't hope it is, because I'm in cash now. I hope it still crashes. But I've got to put that personal view to one side. I'm really surprised he did the 90-day pause, by the way. Then again, I was surprised that 2022, the market fell. I thought that was going to be an up year. I'll just go by what the computer's telling me. And the computer at the moment is still telling me that momentum continues lower for now. So don't, just watch out. Okay. Guys, I better go. If this is the bottom, great. We might end up buying. But if we end up buying, it'll be because we see this kind of an outlook. Or if now what you're saying, this is like COVID and we've had the V-shaped recovery, which, you know, this is it, then we'll see this flattening. If we do, then I might buy. We'll see what happens on the next weekly update. But I'm not in a rush. I'll tell you right now, I am in no way rushed. Trump raised his tariffs on China to 125%. Markets are rallying. Trump paused on tariffs for certain countries. Fine. That happened during COVID. Sorry, that happened during this period here, where you had these, see these moves up. This happens all the time until I'm just going to do late. You're all trying to catch the bottom or predict the future. I'm not trying to predict the future or catch the bottom. I'm not doing that. Can I make it really clear? I'm waiting till this happens, which means I get in a bit late. Can I make that absolutely clear? I'm not trying to read macroeconomics. I am not trying to catch the bottom. I'm not trying to predict the future. I am simply waiting until this happens. If you want to go in early, be my guest, but you're taking a lot of risk, and private investors tend to take a lot of risk. Jeff, you better go. The pause is only for non-retaliating countries. Yeah, that's weird. So that means Britain doesn't get 10% tariffs. Wow. For 90 days. So then what? Oh, we've got to reduce some other tariffs, which we'll be more than happy to do. Makes sense if you were him. But let me tell you and be absolutely clear, I'm going to wait to this period. Why private investors need the dopamine rush to get in and catch falling knives, I'll never understand. You've got to remember, private investors are the riskiest people you'll ever meet. That's why gambling outfits do so well. As a professional, I'd rather be in late. I'm going to be in late. I was out late. I'll be in late. It's fine. It preserves my money. I don't make as much as theoretically I could have done with a time machine. It's perfectly fine. I'm not the only one. Look up Winton Capital. They do the same. Every hedge fund I know does the same. 90-day to next cliff edge. Yeah, exactly. No. 90 days of uncertainty means this momentum continues lower, I suspect. I'm just going by what I've seen historically. It doesn't guarantee the future. That's all. I'm just going by what I've seen historically. It doesn't guarantee the future. I don't know the future. I can't guarantee the future. I'm just saying statistically, this is what's happened previously. And it's done fine for me before. There'll be a link. It'll be alpeshpatel.com/. So the / latest shares. The replay is always on this. The only thing is at the moment, the link I'm going to put you, latest shares, the link I'm going to send you won't show the replay yet because I'm literally doing the webinar. But as soon as this is over, within a short while, the replay should be on alpeshpatel.com / latest shares. Is that analysis better than reading minds of people like Trump? Well, technical analysis is I'm just looking at prices. I'm looking at where people put their money. It's not even technical analysis. I'm just looking at where people are putting their money. Technical analysis would have me putting loads of chart patterns like Fibonacci and Elliott on there. I'm just looking at where people put their money. That's all. There's a temptation. I mean, when I'm on Bloomberg or CNBC or BBC, obviously I've got to talk macroeconomics. But I wish more people sort of understood. It's not what people say that matters. It's what they do. What they do is what they do with their money that matters, not what they say they're going to do or believe or think. So when they start putting their money and average prices start rising, I will belatedly get back in. Very simple. And that simple approach makes enough money. Thank you very much. Okay. Listen, guys, I really better go now. I better check. Can you see me? Turn that off. Okay, I'm going to go now. Oh, I've been wearing a cardigan all day. I came back I was in Florida for a conference during all of these tariff announcements. Like I said, an investor conference, speaking to hedge fund managers, speaking to private investors in America, and they're very calm. I was surprised how calm they are because Europe is with sick bags and nappies the Americans that I spoke to, it might be too small a microcosm of a bunch of investors from around America, but they were very calm about it all. They've seen it all before, like I have. They're as calm as I am. They've seen it all before. Europe hasn't, and it panics. So that's one point I wanted to make. The second point was I was 2 weeks before that in India at an AI conference, and tariffs didn't come up at all. Or stock market wobbles. I think the market had peaked around that time. It's when I first started getting out of stuff. And I'm jet lagged to buggery now, so I better go. Thank you all very much. Despite all of that exhaustion, I wanted to do this because I know it's important for the public at this time in particular, because as you know, I've been a bit hit and miss, infrequent, because I've been focusing on clients. But with this one, I really wanted to get back to you guys and the public as well, because and I can tell from the viewer figures it's been a good one. Thank you very much. Matthew, any plans to hold a meeting for those of us keen to join Great Investments Program? Yeah, just email me, Matthew. Just email me. Or paresh@tradermind.com or alpesh.patel@tradermind.com. There you go. I've just put the email address up. So just email me any questions or anything that I've missed. More than happy to answer on there. Oh, and by the way, you will want this. There's a whole bunch of links with free resources as well. As soon as this is over, I will put the replay on there as well. I better do that straight away because I think a lot of people are going to be waiting. So give me about 4 or 5 minutes as well. Okay, and I'll get that sorted. Okay, thank you all very much. I really better go now. Okay. Mohammed, my pleasure. Thank you for your time and insights. My pleasure, my friend. Right. So that link, my email's up there, and the webinar stuff's there as well. Okay, everyone. Oops, you're over there. You're on that camera. Thank you all very much. I will speak to you soon.